Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin McGrath from Financial Edge Group. Today, we're fortunate enough to be sitting down with one of the experts in the industry. We work very closely with Lonsec, and we're fortunate to have Lucas to help kind of answer some questions about what's happening in the market at the moment. And so let's dive into some questions with Lucas.
Can you talk a bit about how you guys manage risk in your portfolios?
Sure. So from a portfolio perspective, there's a couple of levers we try to use to manage risk, and I guess when maybe it's good to sort of contextualize what we sort of how we view risk. So look, there's many ways to view risk, but I guess fundamentally we try to manage loss of capital. Basically, that's what we think of when we think about risk. So the levers we use is on one side is tilting from a broad asset class perspective, positioning the portfolio for the current, for what we think in terms of the environment going forward will be. So that may be, at the moment, for example, we are still overweight risk assets. So things like equities, for example, things like infrastructure and property, and we are underweight assets like fixed income and cash. And that's really based on a whole variety of things and looking at it from a relative perspective where we think there's more sort of opportunities and value in the market. So we do look to manage risk through that broad asset allocation prism. But then importantly, we then look to manage risk through the underlying investments that we select. And at a very high level, when we think about constructing a portfolio, let's take Aussie equities as an example. We'll tend to want to have, okay, what is that part of the portfolio that is going to give us that long-term exposure to the market? Because over the long term, we do think equities, people are rewarded for taking on equity risk. And that may be, just via maybe an active approach or a passive approach, but effectively gives us exposure to the market. We are also always very cognizant of having an exposure to an investment, a strategy or a style of investing that can do or does do better when the markets pull back. So having like a bit of a handbrake. So that sort of exposure to the market, that will go with the market. Hopefully, if it's active, a little bit better. But then having some kind of strategy in there that what will directionally go up, probably lag when the market's going really well, but when the market has a downturn, hopefully does better than that of the market. So it's about one is having the asset allocation tilts, and then two, ensuring that within the context of a portfolio, there is some defensiveness built in. And diversification is very important. I know it's a term that we all repeat all the time, but one of the things that's always really dangerous in a portfolio perspective is to just be exposed to those part of the markets that have done really well over the last couple of years. And if you think about in recent years, it's been a very interesting market where, despite market returns being really strong, if you look at some parts of the market, it's really been driven by a very narrow number of sectors and stocks. So you want to ensure that you're just not banking on a very narrow part of the market, carrying your whole portfolio. So diversification is important as well.
Yeah, thanks for that. I think that's a really good point you made about your portfolios having a bit of a handbrake on them in down markets. Equally, when they're going up, obviously you're saying you lag it. That's in investor speak what we call beta, but the return you're getting on a risk-adjusted basis is most likely better. So yeah, thanks for that.
Yeah, I think and that's a bit nerdy talk, which is what we do sometimes. And we saw that, speaking on behalf of Lonsec, but we saw that last year with a lot of our clients and the benefit from that the share market did fall pretty drastically with COVID, 37% in a month or something like that. And protection of capital, particularly when you're retired, from our point of view, is really important. And we saw that from the portfolios. And so it's important that our clients have benefited from that through that process. So that's why we work with experts like yourselves.